We continue to see the volatility playing out in the markets. This GTV chart on the Bloomberg just showing how many ups and downs we've had when it comes to the weekly stock moves. In this environment, when we really don't know where we're headed and we're so subject to headlines coming from the coronavirus infections, how do you play defense here?
Well, I think you have to look for the mega technology stocks, which are interestingly now viewed as defensive plays. They have long cash flows that are out in the future, pretty certain cash flows, and at a 0% pretty much interest rate, they're being discounted at a very low level. It's interesting, a lot of the more, which traditionally would be the defensive value stocks, while they're catching up, are viewed as more speculative because they're viewed more as a function of the economy. And then finally, I would say the other place I'm looking that's very interesting is emerging markets. I think with low U.S. interest rates and the prospects of a sluggish U.S. economy through the summer, you wonder if the dollar will weaken, and I think that would be very good for the emerging markets.
The emerging market sphere is very broad, so specifically, where are you looking at, especially when it comes to benefiting from a weaker dollar?
Well, I like Asia a lot. I've been saying this for a while. I very much like Korea. I like Taiwan. I think what's interesting is that China has gotten the message that they can no longer rely on the U.S. reliably for parts. A lot of this is the protectionism and the tariffs and the trade wars. And Asia is going to be the place where there's more diversification. So I'm not recommending these stocks one way or the other, but, you know, I still continue to look at the technology like the Taiwan Semiconductors, the Hanhai, the Samsungs, those kind of manufacturers and tech companies which are going to replace a lot of the suppliers in the U.S. So I think that's an interesting area to look at.
Kirk, does a slowdown in China and some of the geopolitical concerns in that part of the world worry you, particularly as how much of an anchor for Asian EMs China really plays a role in?
Well, you're right. So goes China, so goes EM. So to the extent that China were to have, you know, a large second wave or a slowdown, that would be concerning. It looks to me like China is rebounding, and you've talked a lot, I'm sure, about FIFO, first in, first out, that, you know, China is coming out of the corona wave, whereas other countries like the U.S. and others are still dealing with it. So that'll be interesting to watch. But to your point, I think if China were to slow down, it's obviously going to slow down that scenario.
When it comes to U.S. stocks, so we've talked a lot about the rotation from growth to value, giving kind of this leg up that we've seen in the most recent part of this rally. How much of that continues going forward? Because if you take a look at the makeup of the S&P, for example, it's so heavily weighted towards growth stocks. So where does the next, I guess, catalyst or the next section of the market for the next part of the bull market come from?
Well, it's interesting. The 400, S&P 400, and the Russell 2000, which is the small cap, the 400 is the mid cap, they are catching up to the larger cap. So the gap was pretty wide there for a while. You know, the S&P was down 10, and the mid caps and small caps were down 25. Now, you know, the S&P is down 3 or 4, and the mid caps and small caps are only down 12 or 13, something like that. So they are catching up. I think the mid-caps and the small caps are much more representative of the U.S. broader economy. So I think that the answer to your question on the mid-caps and the small caps, which I see as value, is the general economy going to improve, or are we just going to, you know, continue to have the earnings come primarily from the mega-caps?
Are stocks still compelling with these valuation levels? And how do you feel about bonds? And where would you see any opportunity in the fixed income space?
Well, the big question on institutional investment is exactly that, is what is the future of fixed income at an incredibly low rate environment? I think in the fixed income area, you need to stay to the spread sectors, meaning investment-grade corporates, crossover credits, areas like that, because I think given this rate environment, you're going to be lucky to get your coupon, and obviously if rates were to rise, the duration effect on bonds is going to be negative. So I think you have to look to those spread sectors. I still think they offer value. that's the conundrum here. I mean, stocks in many ways look cheap, but we've had a great run up from off the lows. But when you compare stocks to bonds, it's hard to argue, even at these levels, that stocks longer term don't have value.